Thanks for tuning in for this month's Livestock Market Report. I'm Coulter Brown from the Northern Ag Network. Well, it hasn't been hard to figure out what to talk about in these updates this year. At first it was all-time high prices in the cattle market, then the screwworm threat in Mexico, then tweets by the president, and now the closure of a major packing plant. We're going to dig into what it means for the industry today and if it changes the direction that the cattle industry is on. Certainly, the uncertainty of the industry is quite a bit higher right now, and the need for risk management is critical. We're going to dig into the meat of that after we give a shout out to our sponsor, Nutrilix. Of course, winter is here now, and the last thing a busy rancher wants to do is wrestle feed bags in the bitter cold. Let your trusted local Nutrilix dealer provide your cow's whole herd health with a custom liquid ration. Nutrilix provides the necessary vitamins and chelated minerals along with added protein that fills those nutrient gaps. Choose the supplement proven to help maintain body condition scores and keep your cows working for you. Well, we talked about it for quite a while. With cattle inventories in the U.S. at the lowest in over half a century, packers awash in red ink and excess packing capacity, would there be a closure of a packing plant? Obviously, we can say yes now, as Tyson announced they're closing their Lexington, Nebraska facility and decreasing from 2 shifts to 1 at their Amarillo facility. Combined, those two actions would take 7,000 to 8,000 head of daily processing capacity out of the industry. Obviously, that's not good news for cattlemen to have less hook space, but what does it mean for the industry in the short run and the long run? Well, Tyson did say that they're planning to increase production at other facilities. And we have to remember that we have new plants that have come online this year and are ramping up right now. There's a 2,400 head facility in Missouri and a 1,500 head per day one in Nebraska. That's actually only about an hour away from the Lexington plant. So it's not a total net loss of capacity. We are losing hook space, but it's somewhat offset by these new plants. Now this year, packing plants have been running at about 80% of capacity. Just with the negative margins packers are seeing, there's not the incentive to run as many shifts as they can. If we take the 40,000 head of capacity that would be lost with the Tyson action, that'd probably bring us to 85% of capacity utilization. And as we look towards next year, there's going to be less fed cattle to slaughter just as the industry continues to shrink. So it'll take time to see how this decision affects leverage in the industry. Right now, it looks like we could be moving towards right-sizing capacity with the herd size. That's happened a few times over the last 20 plus years, but it's never lasted for very long. Now, one thing that surprised me out of this closure was the decision to reduce packing capacity while beef demand is so strong. Consumers are still buying beef even at record high levels, and obviously packers want to be positioned to take advantage of that demand, but obviously Tyson doesn't think it's going to grow back, the herd that is, grow back as much, so they made the decision to decrease their ability to process cattle. Now, the news of the Tyson closure came immediately on the heels of an announcement from the Trump administration to remove additional 40% tariffs that had been placed on Brazilian beef. Now, before those tariffs were in place, Brazil had been sending us record amounts of beef this year, so with those tariffs lifted, we'll probably see beef imports increase and may finish the year with a total new record in beef imports. So you add all these bearish news together, and we've seen a lot of pressure on the market. You know, feeder futures have dropped more than $50 in the last 6 weeks. So with uncertainty that high, it's probably going to cause more caution from producers as they make their herd rebuilding decisions. You can see what the futures here have done over the last month and the last 3 months here. And of course, in the last 2 months, it looks like prices have been near free fall. But you pull back and you can see that we're still at a very strong level. Comparing back to where we were this time year ago with those same contracts, feeder cattle are up $60 to $70 year over year, whereas live cattle are $30 higher. So the price is dramatically above where we were last year, but we've taken a lot of shine out of this market. And as you look at just the month over month movement, feeder cattle futures, they're down probably $5, maybe $7 on the high end. Live cattle losing more on the front month contracts, down $14 on December, but most of our 2026 contracts $5 to $8 lower for the month. One of the other big concerns that was talked about a lot in November was the southern border with Mexico, whether that would be reopened as Mexico tries to get a handle on the screwworm threat. USDA and Mexico have been collaborating on countermeasures to battle screwworms, and there's no confirmation that it's got any closer to the U.S., still about 70 miles south of the border. If that border does reopen, it does present more downside risk to the market. Ag Secretary Rollins somewhat quelled those concerns when she said that when the border reopens, it'll be a phased reopening. So for the 5 major ports, they're not all going to open at once. So it'll be a slower increase of cattle, but they will be coming back to the U.S., which likely to put pressure on our market. All those headlines certainly overshadowed the first cattle on feed report that we'd seen in 2 months. Placements were pretty bullish, coming in 10% below year-ago levels and the lowest October figure on record. The total inventory still run at about 2% below year-ago levels. We also had the quarterly steer and heifer breakdown, which showed heifers making up 38% of the total on-feed number. Magic number that everyone's watching for is 37%. That's the figure that historically tells us heifer retention is happening. So with that many heifers still on feed, it's hard to call it an expansion phase. Now, the cash-fed cattle market did really get beat up in November. We're talking $20 to $30 drops over the month here. So taking a lot of the premium that was there, not much basis between the futures and the cash at this point. It has dramatically improved packer margins as the price of beef has held steady, but cash cattle prices fallen dramatically. So packers like that movement quite a bit. The other thing I want to mention, the Trump administration has placed a major emphasis on decreasing the price of beef. Back when the president first made the announcement about increasing imports from Argentina in mid-October, that caused kind of the start of the drop in the cattle market. Since that time, feeder futures have dropped $54, live cattle futures off $32. Box beef prices, though, about flat. Actually a skosh higher, and just a few days ago they were quite a bit higher. So really in the last 6 weeks, we've done a lot to decrease the price of cattle, but the price of beef still remains high. And as we wrap up looking at our local markets here, 6 weeks ago, calf prices were at record highs. As you'd expect, they've come down, but still a very profitable year for cow-calf producers. The last sale at Stockman's Livestock in Dickinson, the light 5-weight steers averaged $4.47, upper 5 weights at $4.30, and the light 6-weight steers still averaging just under $4 a pound. That's $2,400 a head for these calves, so still some strong values. Look at what we've done over time here. Yeah, in the last 6 weeks, we've dropped $56 a hundred on these calves, but year over year, we're up 33%. You go back 3 years, the calf price is over 100% higher, $227 a hundredweight more that they're bringing today than they did 3 years ago. As we look at what the futures, or not the futures, excuse me, the video did this summer, it was higher and higher every month, but we've obviously backed off of that. We're kind of back to where we were on the July video, which, if you remember, that was the highest price anyone had ever seen. So still a very strong calf market. Looking at the weigh-up market, there's been exceptional prices this year, but it's really followed the same seasonal trend. We are seeing pressure on the weigh-up cow prices just with the volume of cows that come to town with the fall culling that happens. Most of those average dressing cows probably $5 to $10 lower, $164 to $174. Lower dressing cows seeing a wider range and falling a bit more, probably more like $10 to $15, with the average at $147. Slaughter bulls down about $5 from $180 to $190, and the young open cow market, it's been exceptional this fall, backing off $5 to $10 in the last month, but still some very strong prices on those young open cows. One of the big stories, though, is the bred cow market that is really picking up steam and some strong prices. At Torrington Livestock, we saw bred heifers top out at $5,500. The young bred cows averaging $4,534. Year over year, that's a 40 to 50% increase on these bred cattle. I mean, we're talking $1,000 to $1,500 a head more than they were bringing a year ago. Go back to 3 years, we're up 120 to 130%. So some wide gains in these bred cow prices, and you can see the range on these prices has increased dramatically over time. 3 years ago, there was only about $600 between the running age cows and the bred heifers. Now there's, more like, $1,800 between those running age cows and bred heifers. So a wider range as ranchers get to be a bit more picky right now. And of course, we're into production sales season. A lot of bull sales happening right now. The big story hot off the press is the Vermilion Ranch sale that saw some outstanding prices. The bulls averaged $16,000. Fall yearling bulls actually over $18,000. The coming twos at $14,000. 1,300 commercial bred heifers averaging $4,300. So most of these bull sales are 20, 30, 40% above last year. And wrapping up with the sheep market, it's largely been overshadowed by the cattle this year, but boy, a very nice fall for our sheep producers. There was some uncertainty on the summer video for lamb prices, but it's rallied back very strong. We're talking 30, 40, even 50% above year ago levels. 70-pound lambs bringing $1 a pound more than they did last year. So that should make our sheep producers pretty happy. There's a lot more volatility in lamb prices, but like I said, they've made some nice gains this fall. Well, that's going to wrap up this month's report. Thanks so much for joining us. As we look forward, there's a busy bred cow marketing time frame coming up in the beginning of December. We'll wrap up the fall calf run, and after the holiday break, I think there's potential for this market to really find its seasonal rally that it typically does in January and February. The real uncertainty remains around the screwworm threat and when the border reopens to Mexican cattle, but we're still talking prices that are dramatically above where they were a year ago, despite taking some of the shine off those prices this fall. Uncertainty remains high, especially with that packing plant closure, but being that we can't really say that we're growing the herd yet, it looks like these prices continue to have some staying power. Thanks for joining us for this month's report. I'm Coulter Brown, Northern Ag Network.